What happens when the debt cannot be repaid? For an individual or even a business, when the debt exceeds the ability of the borrower to pay back, some sort of agreement is reached between the borrower and the lender. Sometimes that agreement simply looks like, I can't pay anything, you're not getting anything back. Sometimes that agreement looks like, hey, we're going to restructure this debt, so maybe it'll take me longer to pay you back, but you'll still get everything back. And then sometimes it's going to be somewhere in between. But what happens when you take a look at all the debt the entire world has accumulated and realize that for a number of factors, there is no way for that debt to ever get repaid? Does the can just keep on getting kicked down the road, as the saying goes, forever? Or is there a point where things actually start to break? Well, first, let me show you why the debt actually cannot be repaid, and it starts with the money supply. This chart that you're looking at here is a chart of the total money supply inside the US banking system. And as you can see right now, it is sitting at right around $20 trillion. Now, $20 trillion is certainly a lot of money. And as you can see, that is more than it was at prior to the money printing starting in 2020, when the money supply was only around 15 trillion. But even that was a lot higher than it always was before, as the money supply just continues to grow and grow throughout history. But $20 trillion is actually not that big when you compare it against some other numbers. For instance, the current national debt, the number of dollars the United States government owes to lenders, is $33.6 trillion. That's right. All of the dollars are 20 trillion, but you look at the number of dollars the government has borrowed, and it's 33 trillion. So the amount of money the government owes to lenders is more than all the money in existence, but it gets worse. This right here is a chart of household debt, not including mortgages, and we can see student loans are about 1.5 trillion, credit cards are around $1 trillion, auto loans are around 1.6 trillion, and when we include housing debt, mortgages as well, we're sitting at a whopping $17 trillion. So the amount of money that the government owes back to its lenders is 33 trillion. Add on top of that the amount of money that households owe back to lenders, and you are now at 50 trillion combined. Yet the total number of dollars that there are is less than 21 trillion. And this does not even include corporate debt. But let's take it one step farther and look outside of the US, because dollar debt is a global market, not just confined into the United States. Currently around the world, there's $65 trillion in hidden debt. This is dollar debt that is not accounted for through things like off-balance sheet debt in non-US banks and off-balance sheet debt for non-US shadow banks. Now, certainly there are global dollars outside of just the money supply that exists in the United States as well. This is called the euro dollar system, and I've made a few videos explaining that in detail. But the very existence of those euro dollars is actually debt in and of itself. And so no matter which way you slice it, there's far more debt that needs to be repaid than there are dollars to be used to repay it. Now, you're probably thinking, if those dollars don't even exist in the first place, then how did all that debt get built up to begin with? How's it possible to borrow money that's not actually there? And the answer is rehypothecation. Your dollar has gone through one loan to the next, to the next, to the next, but it's the same dollar. Here's how that works. You take your $1,000 and you deposit it in your checking account. At that moment, you have $1,000, and you can get that $1,000 at any time you want. This number of $20.7 trillion would increase by $1,000. That bank then turns around and takes $900 of your $1,000 and loans it to the US government by buying a treasury. The government then gets that money, because that's them borrowing it. They take that $900 and they spend it. Let's say this $900 goes to somebody's Social Security paycheck. And then that senior citizen gets that deposit of $900, puts it in their bank account. But then that bank takes, let's say, $800 of that $900 and loans it out to somebody to buy a house in the form of a mortgage. So to you, it looks like you still have $1,000, and to the senior citizen, it looks like they still have $900. But in fact, there are multiple loans along the way. This is how the modern fiat money system works, is that money is loaned into existence. And so the amount of debt debt grows faster than the actual money supply. For every dollar that exists, you can have many times that number of dollars in loans. Now, if you're tracking, at this point, you're probably thinking, well, if that debt then can be built using the same number of dollars in the system, even though there's more debt than dollars exist, then that whole process could be unwound, right? And you should theoretically be able to pay off all of that debt with the existing number of dollars, right? Well, the answer is yes and no. Theoretically, we could see a spike in the velocity of money. The velocity of money is simply a measure of how fast money is circulating in an economy. And so with the same given number of dollars in a closed loop economy, moving around twice as fast, my income might go from $100,000 to $200,000, even though it's the same number of dollars circulating throughout the system, they're just going faster. We could absolutely have a deleveraging that way, but there's one big problem with the way that it has happened right now that will probably prevent that. And that is what interest rates have done for the last 80 years. From 1940 all the way through 1980, interest rates were increasing along with inflation. They both peaked in the late 70s, early 80s, and for the 40 years following 1980 through 2020, interest rates fell, while inflation fell as well. But interest rates can't go much lower than 0%. At least for a sustained period of time, and interest rates bottomed in 2020, and we have embarked on a new cycle that will mirror the last 40 years, in other words, going up instead of down, and look more similar to the prior 40 years from 1940 through 1980. Essentially, the last 40 years of interest rates moving lower and lower and lower has made the cost of servicing existing debt cheaper. This makes sense because if interest rates go from 5% to 2.5%, you could afford to double the amount of debt that you have with the same payment. So for the last 40 years, if interest rates have moved lower and lower and lower, that has allowed a large levering up. Look at this from a personal finance standpoint. Let's say you have a credit card that you're able to afford a $10,000 balance because it's a 20% interest rate. But a couple years later, they lower your interest rate to 10%. So now you're able to afford to put $20,000 on the credit card. They continue to do this every couple of years, lowering your interest rate until you've realized one day you look up and you realize you've built a balance of $100,000 on this credit card. Now your rate is only 1%, so you're not worried about it, but the problem is they're about to start raising your rates. So as interest rates are now climbing at an extremely quick pace, they're doing so on one of the largest over-leveraged economies we've ever had in history, which means that many economic actors can barely afford to continue paying for just the debt service costs, just to keep their debt, let alone continue to grow more debt. In other words, we are in a new part of the long-term debt cycle, with the last 40 years having ended and the new phase of the cycle having begun. This is a phase of deleveraging because it no longer is affordable to maintain the existing debt load. But as we've covered before, there's not enough money right now for that debt to get paid off. So what are the options? Well, it turns out there are only 4 potential paths that this could take. We will discuss each one of these paths in isolation as if that is the only path that could be taken. Although in reality, we will most likely see a mix of all 4 of these paths unfold at the same time. But it's important to talk about them in isolation to fully understand how each path looks. Path number 1 is debt jubilee. The idea of a debt jubilee goes all the way back to thousands of years ago with the formation of the nation of Israel. And in their constitution, the instructions given to them on how to run their nation, they're to have a year of jubilee in which all debt is forgiven. There's no record of this actually happening, but the idea of debt forgiveness, especially through war or revolution, is consistent throughout history, especially during times of over-leverage. And right on cue, we have small isolated incidents of a debt jubilee, debt forgiveness, like Biden administration looking to cancel and forgive student debt. When the debt load for a particular people group becomes so large that it looks like they cannot pay it back, and that the ones who have the power to do so look like they could gain something, whether it's power or money, by orchestrating that forgiveness or that jubilee, you tend to see that pushed more and more. Now that's one example of a debt jubilee or debt forgiveness that we can look at happening in real time to a specific small group of people. But there's actually another example of this that may be even larger and could very realistically unfold over the coming years. And this is actually the federal government's debt getting forgiven. Now you might be asking, how in the world could that national debt of $33 trillion get forgiven? And it's actually very simple. First, we have to understand what this is. This is the Federal Reserve's balance sheet, which currently sits at around 7.9 trillion, although at its peak in 2022 was almost 9 trillion. But first, a word from today's sponsor, I Trust Capital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where I Trust Capital comes in. I Trust Capital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing and traditional banks like Silicon Valley Bank are failing from bank runs, I Trust Capital is still going strong because they do things the right way. You own your assets there. Your assets are always held off balance sheet and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. They are straightforward about how they keep your assets separate and safe. And if you use my link in the description below, you will get $100 worth of Bitcoin just for signing up. You can think of the Fed's balance sheet as its brokerage account. It is simply an account that holds assets. The assets that the Fed's balance sheet holds are primarily mortgage-backed securities and United States treasuries. These are both debt instruments, and in the case of the treasuries, it means that the United States government actually owes some of that national debt to the Federal Reserve. Because the Federal Reserve has a monopoly on the creation of US dollars, when it buys US government debt, that is a way to get cheap debt to the government. But it could get even cheaper than most people expect. Because right now, even though the Federal Reserve has $8 trillion on its balance sheet, it's currently operating at a loss. Normally it operates with profits, meaning it has all of its assets, those assets pay it some income, and then it uses that income to pay for its expenses. The way the Federal Reserve works is that anything left over after its expenses goes straight back to the government. That's right, the Fed actually keeps no profits for itself. It pays for all of its employees, it pays the dividends to its member banks, it pays the interest on the reserves and on the reverse repo balance. If there's anything left over, that all goes back to the government. Now, right now, there is actually nothing left over. They're operating at a loss. Now, I've explained that chart in the past, why it looks so crazy bad, but essentially it's because of an accounting change. Once that number tips negative, it becomes cumulative instead of showing the weekly amount. If you show two separate charts for the cumulative total and the weekly total, this is what it looks like. This is a chart from Lynn Alden, where it shows in blue the amount that the Fed was sending to the Treasury when it was profitable, and then in blue over here is the amount each week that the Federal Reserve is printing to cover its expenses. The orange line shows the cumulative total since 2011 that the Fed has paid to the government, and this dip down recently is the amount that they have not paid. Now, there's a third piece to this puzzle here that we have to look at before we can put them all together to understand how the government could get its own debt jubilee. And that is the fact that interest rates on government debt have gone from basically 0% up to basically 5% in just the last couple of years. This means that anybody who is holding those treasuries who loaned money to the government prior to 2 years ago is currently sitting on massive losses. And in the case of the ETF TLT, which holds 20-year treasuries, currently sitting at 50% losses. Now, it's possible that this causes some forced sellers because as asset holders become distressed, as life gets more expensive, as nations have to sell treasuries in order to be able to defend their currency, and as one person selling pushes the price down, which causes other people to sell, there are all sorts of situations that it could occur that could cause a sell-off in treasuries. And if the Federal Reserve were to print money to buy all of these treasuries, their balance sheet would explode again. Let's just say they were able to orchestrate the ability to buy up the entire national debt, and the Fed's balance sheet was in excess of $33 trillion. Well, then the entire national debt essentially becomes interest-free because yes, the government right now has to pay an interest rate on that entire $33 trillion of debt. Right now, all that interest is going all around the world. But if the Federal Reserve buys up all of the national debt, then every dollar that the government sends in interest to the Fed comes right back to them. After paying the Federal Reserve's expenses, the entirety of the national debt essentially becomes an interest-free loan, which basically just means it's not a loan anymore. If your left pocket owes money to your right pocket, does any debt really exist? So this is the first path, debt jubilee, debt forgiveness. And we'll certainly see some of it in the coming years. The second path is a deflationary deleveraging, and this is the one that most people think we cannot see. We will not see, that policymakers won't allow, which means in my opinion, it's probably one of the biggest black swans to be prepared for just in case. A deflationary deleveraging is sometimes also called a death spiral. This is a situation where as some people suck dollars out of circulation in order to pay off their debt, that means they're not reintroducing those dollars back into the economy. So that means their income then becomes money that ceases to exist, is no longer their expense income, which means somebody else's income goes down. This will certainly force some people into default because they won't have enough income to service their debt anymore. As debt is a liability for the borrower, it is also an asset for the lender, which means that lenders who have their loans defaulted on will be distressed and some of them will go bankrupt. This deflationary death spiral that I'm describing is what most people were very scared of during the financial crisis. As debt that is realized to be bad and some people are not paying, that means that eventually you get a domino effect where financial institutions start falling over. But as we took a look at the money supply, every dollar was already loaned into existence. So if one bank goes under, then all the dollars that existed at that bank suddenly cease to exist as well, which means that money cannot also be used in order to pay off debt. This contributes to a very rapid decline in asset prices and prices of goods and services as the money just starts evaporating from existence. As money becomes more scarce, it becomes more valuable relative to everything else, which is another way of saying prices collapse overnight. This is what happened during the Great Depression when people went up to the bank to try and get their money and realized the bank was closed and the money didn't exist anymore. This does result in a deleveraging because the debt ceases to exist, mostly through defaults. It is an extremely painful economic situation, although if you allow it to just unfold, then typically it's very short-lived and things recover quickly afterwards. A great book on this is The Forgotten Depression by James Grant. If you're interested in learning more about a situation in which a deflationary deleveraging was allowed to unfold naturally with no intervention from central banks or central governments. The third path, which most people view as most likely, is the inflationary deleveraging. Now, in order to stop the deflation from occurring, anytime there's some sort of default that may happen, the central bank prints the money in order to cover it. This is the situation that occurred with the failure of Silicon Valley Bank, where if that bank would have been allowed to fully fail, then all of the money that existed in those accounts would have ceased to exist. So instead, that money was reprinted so that the money supply would not shrink. As we continue to see more and more problems caused by interest rates going up on the most over-leveraged economy in history, many people think we are more likely than not to see more examples of this where money is printed in order to cover up the defaults in order to bail out what is necessary. As a result of the money supply expanding from these small isolated bailouts, you still have deleveraging occurring because debt is getting paid off as a result of the higher debt service cost. But because that money is coming into existence through printing, there's more money in circulation, which means that prices go up. And then finally, this is, in my opinion, probably the least likely, but it is still a potential outcome, and that is a productive output boom. To understand this, we need to look at this from a personal standpoint. Imagine you spend $5,000, $10,000 in order to go to a computer programming boot camp to learn a new skill. You don't have any money, so you go into debt. You're working a basic job right now, let's say making $40,000 a year. You borrow $10,000 to pay for this boot camp, and a couple months later, now you have a new skill. That new skill allows you to go get a job that pays $100,000 a year. While the cost of servicing that debt of $10,000 still exists, your quality of life has actually improved because your income increased increased by so much that even when you have to subtract some of it to pay off that debt, you're still in a better position now than you were before without that extra income and without that debt service cost. This is an example of how debt can sometimes be used, especially on an individual level, in order to increase productive output. This is true both with individuals and companies and society. For thousands of years, we have seen examples of this take place where you have booms in productive output, usually centered around a new discovery of a form of energy or a new technology. The agricultural revolution, the industrial revolution, heck, even the last 30 to 40 years with the internet boom. We have seen massive increases in productive output, which have offset the pain of the increased leverage. It is possible that we are on the brink of more discoveries and more increases in productive output and new technologies that will continue that and allow us to continue to maintain the debt burden or even deleverage without feeling the pain of that. But given the size and the cost of the leverage, to me, that seems less likely. Now, if you're in a position right now where you're thinking to yourself, I make good money, I've got a decent sized portfolio, but I have no idea how to play this, especially considering we could go one of two ways. We might see a inflationary deleveraging, we might see a deflationary deleveraging. This is exactly what I help members of Heresy Financial University do. It's vital that you learn how to construct your portfolio in a way where you're not betting on one or the other, where you're growing your wealth regardless of what the economy does. This means hedging against both inflationary outcomes and deflationary outcomes. This means understanding real risk management so that you stop losing money on bad trades just hoping it'll get back up to even so you can sell at a very small loss. Heresy Financial University has a massive library of training material that'll teach you portfolio allocation, advanced options, strategies, fundamental analysis, and a ton more. I'm constantly adding new courses to that library. Members get access to everything. We do monthly live stream group coaching calls. I'm adding a few new exciting features soon. And the best part is, once you become a member, your pricing gets locked in forever. And it's getting to the point where there's so much available to members that I'm going to be raising the price pretty soon. But if you get in now before the price goes up, then your price is locked in as long as you're a member. And considering right now it costs less than most people spend on Starbucks every day and how much more you're going to be making as a result of implementing everything you learn, you can't afford not to become a member. Link is in the description below. And as always, thanks so much for watching. Have a great day.